Welcome to Principles of Risk Management Insurance, Chapter 17. Today we're going to talk about retirement plans and other similar employee benefits. Some of our learning objectives are we're going to talk about the tax qualified plans. We're going to explain what a private retirement plan is, what a pension is, retirement ages. We're going to look at defined benefit and defined contribution retirement plans. We're going to talk about the features of the defined benefit plan, as well as describing the defined contribution retirement plans. And we're also going to talk about early retirement. We're going to talk about the Employee Retirement Securities Act. So let's get started with the fundamentals of private retirement plans. Now, retirement is a big issue for everyone, and understanding how these different retirement plans work will help to enable you to have a more secure retirement. In addition, it also enables you to explain these retirement plans to various clients if you wind up working as a financial advisor. Excuse me. So the first thing we should talk about is the Employee Retirement Income Securities Act of '74. Now, this was the basic act that enabled the 401k to be developed. And it established some minimum standards in an industry that was not so well regulated before this act. Then in 2006, they developed the Pension Protection Act, and this was an act that obligated employers to maintain a certain amount of funding for their pension plans. Previously, many pensions were underfunded, or companies had an inability to meet the commitments of their pension plans. So this act was enabled to help make sure employers took more prudent steps in securing funding for their retirees. Now, in addition, employee contributions are deductible, and employers' contributions to employees' retirement plans are tax deductible as well, but within certain limits. And we'll talk about those limits for both the employer and the employees. Now, what's great about the earnings on these investments, for most plans, these assets are going to accumulate on a tax-deferred basis. So what that means is as you earn profits on your investments, in the normal world, you would have to pay tax on those dividends or those capital gains every year. But in a retirement plan, you get to defer those taxes until you actually retire. Now, we're also going to talk about private plans, and they need to meet certain requirements. And if they do meet certain requirements, they'll become what's called a qualified plan. And these qualified plans receive favorable tax treatment, which is really important for growing our investments until retirement. Because if we can put money in that is not taxed, that's a lot more money to invest. So for example, if for every $100 you want to save for investment, if you do it in a retirement plan, you'll save $30 in taxes that you normally pay when you earn $100, depending on what state you live in and what tax bracket you're in. Okay, so moving on. Okay. Qualified plans must benefit the workers. So when a company puts together a retirement plan for their employees, it should be there to benefit all the workers, not just the highly compensated. And this was a worry that some retirement plans were going to be designed to really benefit the higher waged employees. So they've come up with a minimum coverage requirement that is sort of a ratio. So what they're looking at is the percentage of non-highly compensated employees covered under the plan must be at least 70% of the total compensated employees who are covered. Now, so they use the average benefits test. What we look at is the non-highly compensated employees, and they have to be at least 70% of the average benefit provided to all the highly compensated employees. So again, each company would have to do the math on this to figure out who falls in the highly compensated group, who falls in the non-highly compensated group, and they want to see that there's some equity and parity between the benefits dished out between the two groups. So now if you're in the highly compensated group, which might only compromise a small number of people in the company, you may not, if the company doesn't pass this benefits test or the ratio percentage test, some of the money that you set aside in your 401k will be returned to you to get those ratios to where they need to be. And this is all in trying to make these plans be fair to all employees. Okay. Now, if we look at most pension plans, they're going to have an age and service requirement that has to be met. So eligible employees who are over 21 and completed 1 year of service are generally allowed to participate in the plan. So non-retirement age employees over 21 typically would be a participant in the plan. Now, when we look at normal retirement age, this is going to be an age where you can receive your pension benefits with the full benefit, and usually it's at 65 currently. Some people do retire early, and if an employee retires early, that can be they're going to receive a retirement benefit, but could be reduced. Now, there's also the deferred retirement age, and it's any age beyond the normal retirement age. So some people don't want to retire at 65; they want to continue working, and that pension plans and retirement plans need to take that into account. In some countries, there's a forced retirement age where people have to retire at a certain age, but not in the U.S. People can retire when they feel that it is appropriate. Okay. Now, vesting is a concept of how long it takes until you can access the money that is contributed by the employer into your retirement plan. So employers typically will contribute to your retirement plan. That depends, the amount they contribute depends on the employer and how much their plan offers. So, under a qualified defined benefits plan, and that's any plan that meets the qualifications, that's going to be tax deferred, they must meet a minimum vesting standard. So under a 5-year vesting, workers, you must be 100% vested after 5 years of service. So that's, you can't stretch your vesting beyond 5 years. So after 5 years, you're 100% in. Under a 3 to 7 year graded vesting, the worker must complete 20% vested by the 3rd year of service and a minimum vested of another 20% for each year until the worker is 100% vested in 7 years as an alternative. So this is meant to encourage people to stay at the company. So, and also meant, so if the company does give out matching funds or contributions to an employee plan, that they're meant for retirement, and they don't want people to sort of work a year or two and then take the vested money with them. So that's why they prorate it per the amount of time worked. And for many employers, they do like this because it does promote some longevity in your working life there. Now, there can be faster vesting plans developed. So for qualified defined contribution plans, you want to encourage employee participation, because generally employees may not, especially the younger employees, may not see the benefits of joining the defined benefit plan initially, because retirement may be something that they're not thinking about right now, or they have other things in mind with their money and they don't want to set aside anything for retirement. So having a more aggressive 3-year vesting plan where employee contributions will be 100% vested after 3 years, that's going to be more encouraging. There could also be a 2 to 6 year graded vesting where the worker must be vested 20% by the 2nd year of service, and a minimum vesting increases by an additional 20% each year until they reach 100% in the 6th year. So these are just different vesting platforms. Now, again, the two most important things about vesting is, one, it encourages employees to start their participation. The sooner you start the participation, the quicker you'll meet your 100% vesting, and also to encourage longer term employment. Now, as far as withdrawal, you can withdraw funds at any time from a qualified plan. However, if you withdraw the funds before age 59 and a half, you're going to have to pay a 10% penalty on this early distribution. Now, pension contributions cannot remain in the plan indefinitely. So if you reach age 71 and a half, you have to start receiving distributions from your retirement plans at this point. Keep in mind, many of these pension plans are going to be integrated with Social Security. So they're going to take into account the fact that you're going to receive Social Security. So the pension benefits, for highly compensated employees without increasing the cost of living benefits to lower paid employees. So it's an integration method. Now, employers must also follow this integration rules, which are called permitted disparity rules, and that limits the employer's contributions made on behalf of highly compensated employees. So basically, Social Security is a factor in your retirement, and when you look at your retirement payouts that you're going to receive on a monthly basis, you should keep in mind that Social Security is going to make up a part, not all, of your retirement money. Now, the different types of qualified retirement plans, there are two basic types: defined benefit plans and defined contribution plans. Now, we're going to go into these in more detail, but let me just say that the less common is the defined benefits plan. This is what you would think of as an old school pension. So an old school pension is one where employers ahead of time of what you're going to receive when you retire. So they might say, this pension will pay out 70% of your salary in retirement. So in many cases, the employers will contribute the funds needed for your pension benefits. In some cases, they may ask you to contribute some money to it. Now, pension plans are being phased out, have been continue to be phased out since the early 80s, as employers realize that the defined benefits plans or pensions are much more expensive and require much more financial obligations of companies to employees. In addition, employees do worry about companies going out of business or companies not properly funding the pension plans. So if you have a pension plan with an employer, they can get disrupted by a company going bankrupt or a company misappropriating funds. So pension funds can be vulnerable. Typically, though, as an employee, you'll probably contribute less and get more out of a pension plan. It's one of the reasons employers have been discontinuing them, because it's much cheaper to offer a defined contribution plan. So with the defined contribution plans, they sort of flipped it and made the employees pay most of the money into the retirement, with employers paying a small amount. So with the pensions, the defined benefit, that was a benefit that was mostly funded by the employer. The defined contribution is a benefit that's mostly funded by the employee. So it's much cheaper for the employer to have a 401k plan than a pension plan. But there are different rules that apply to each plan. But this is just one to explain the motivation away from pensions and into 401k type of vehicles. Now, as time has progressed since the 80s, companies have been chipping away or whittling away at employee benefits. So a way for a company to increase profits is to decrease the amount of employee benefits. And removing pension plans was one big step in saving huge amounts of money for many companies, but at the detriment to many employees. Okay, so let's talk a little bit more about that defined. So whenever you hear defined benefit plan, think pension plan. So this is where the retirement benefit is known in advance. So with a 401k, we don't know exactly what we're going to wind up or our monthly income is going to be until the end. With the pension plan or the defined benefits plan, they tell you ahead of time, if you work this long or if you make this much money, this is how much you'll be paid in retirement. And the reason they can do that is because they use the mathematics and the statistics of the growth of the stock market, the amount of money going in, the time value money and compounding of it. So they have a really good idea of how much money will be accumulated in this account after, say, 20 years of working. So that way they can give you a defined amount of money that you'll receive during retirement. And that's one of the great benefits of a pension plan, is you really can plan better with it, knowing how much money you're going to receive in retirement. Now, the amount is going to be variable depending on the plan. One example, so on average career earnings, you could look at the final average pay. Generally, the highest 3 to 5 years of earnings can be the basis of your pension payout. And some firms may give employees a past service credit for prior service in the company. It all depends on how the employer wants to structure it. Instead of saying defined benefits plan here, I'm just going to refer to it as a pension plan as we move forward. Now, there are maximum annual benefits that are limited to 100% of a worker's compensation. So they're saying that in retirement, you can't make more than your average compensation for the 3 biggest or consecutive years of earnings, or $220,000, whichever is lower. Now, and these are based on rules are set up in 2018, and these rules and these amounts change quite often. But the maximum annual compensation that would be counted in the contribution benefits formula plan for all plans is limited to $275,000 at the current time. And as inflation increases, these amounts do get adjusted, but this is to give you an idea of where you're working from. And for most people, their highest consecutive years of earning are going to be below $220,000, or to calculate the maximum annual compensation, they don't have to worry about that $275,000 top end. Those are really just for very highly compensated employees. As far as how the pension plans decide on how much you're going to make, there's a couple different ways of doing it. So you have a unit benefit formula, and under this formula, both earnings and years of service are going to be used for calculating this amount. So the retirement benefit might equal the percentage of a worker's final average pay multiplied by the number of years of service. So the final average typically includes 3 or 5 years of salary, and it all depends on the pension plan and how it's originally set up. So if the pension plan could provide 2% for each year of service for a worker, for final monthly starting average salary of say $5,000, and 30 years of service, they might receive retirement benefits of more, even more than that. It's all based about how much time you've put into the company, and your salary. So this unit benefit formula is some sort of formula that's going to look at time and money made to figure out what your ending pension monthly benefit will be. And there's also a flat percentage of annual earnings. So, under this, it's going to be a fixed percentage of what you make. And this is usually easier for employees to comprehend. So you might get, anywhere from 30 to 60% of your salary paid to you every year in retirement. So it's going to be based on your average earnings, say in your final years of work, or your highest compensated years. Now, so the plan might provide 60% of your final pay if you work 30 years of service. However, if an employee only worked 20 years of service, it might be down to 40% of your final pay. So again, the longer you work for the company and the more you make, the more you're going to get in your pension plan. And again, this is another way of encouraging long-term employment. So in today's age, most people change jobs every 2 to 5 years. But if you had a pretty strong pension plan that was going to give you a really decent payout upon retirement, you might think twice before changing jobs. Okay. There's also a flat dollar amount for each year of service. So under this formula, a flat dollar amount was going to be paid for each year that you're working for the company, what we would call credited services. Now, so for example, if the plan paid $50 monthly at the normal retirement age for each year of service, so if the employee had 30 years of service, then the monthly pension would be $1,500 a month. But there also could be a flat dollar amount for all employees. So for this formula, it's sometimes used in, say, a union, or they might do, which would say there's a flat dollar amount. So it doesn't matter how much you make. So a flat dollar amount will be paid to all employees regardless of the years of service. So it might be, you may have only worked 5 years, but the bottom line is, everybody who worked for the company is going to get $800 per month, no matter how much they've worked or how much they've made or how many years they worked. So there can be a set of sort of a bare minimum floor. Now, because of the risk, since the money is in a 401k, the money is in your name. In a pension plan, the money is, more legally associated with the company. So in order to make employees feel a little less concerned about the financial strength of the company, there is this entity called the PBGC, which is the Pension Benefit Guarantee Corporation. So it's going to protect employees against loss of pension benefits to a certain limit if the plan should be terminated. And this is something employers can do. They can just say the plan is done, it's terminated. So you're guaranteed the maximum guaranteed pension at age 65 is $5,420 per month. So, this is a federal, corporation that's going to guarantee payment of vested or, benefits up to a certain limits if a private defined benefits pension plan is terminated due to, say, a bankruptcy. And this has happened plenty of times. So this, some sort of formula they have to use to determine the maximum benefits. And as I said, it's about $5,400 currently. And what this is meant to do is help protect employees against, a company going bankrupt, which is something that has happened, and it can be very devastating to the employee. So this is definitely something that if you have a pension plan, you want to make sure that they meet the requirements to participate in this guaranteed safety. It's sort of like the FDIC for banks, where they're going to guarantee your bank accounts if the bank fails. So again, it's just something to kind of protect employees a little bit more. Okay, so let's look at the cash balance plan. So this is a different type of plan. Excuse me. So in this type of plan, and this is, would help reduce pension costs in a traditional pension plan. So with the cash benefit plan, this is another defined benefit plan, which means whenever I say defined benefit, it means that they're going to define what your pension payouts are going to be. Now, the benefit in a cash benefit plan is going to be in terms of guaranteed fund balance at retirement rather than a pension. So it's going to guarantee the amount of money that you're going to have, in total dollars upon retirement. So with most of these cash balance plans, the participant is going to be credited a certain amount of money every year, say, anywhere from 1 to 10% of their total compensation, the total wages they make. And then there's going to be an interest credit, a credit for interest earned on the funds. So the longer you work, the more this cash balance builds up. And so the benefit of this is it's not a pension. They're not promising you future annuity of payouts. So with a pension, you get this future annuity of payouts of $5,000 a month every month for the rest of your life. And that's one good thing about pensions is that, they're based on payouts for as long as you live, generally. Where 401ks and cash balances are, you just get a lump sum of money at retirement, and then you have to plan out your retirement with the money in the account. So every year, if you're a participant in this, you're going to get paid a base amount of money will be placed in this account, so like a savings account for your retirement. So the employer, your employer is going to bear the investment risk and any realized gains or losses, and the employees, will be converted. So the employees will receive upon retirement the balance of this account. So basically, it's sort of a fake account in the way that they're saying we're going to put 10% of your salary in this account, and when you retire, you're going to have 10% of your salary over 20 years plus interest. Now, that doesn't mean the company has to actually put aside that same, that value of that account day one. The employer gets a chance to build that account, hopefully through their investments in there. They're able to, only contribute a smaller amount of money, and hopefully the investment gains and interest will make up the bulk of this account upon your retirement. So it can be a more inexpensive way for an employer to provide a defined benefit. These are not as popular, so you probably won't run into that. So, for example, here's a slide looking at we're looking at a 35-year-old and a 55-year-old. This is the annuity or the retirement benefit, and we have the cash balance formula, traditional defined benefits formula, traditional. So if you look at these are the two. So you see that the 35-year-old would have more money in the traditional defined benefit formula rather than the cash balance formula. So that's why it is cheaper for employers to work with this. It's not as beneficial for employees because you're not going to have, in either case, 35 or 55, you're not going to have as much money in your cash balance formula than you would in your traditional defined benefit. So this model is based on an assumption your salary is $40,000 and you have 10 years of tenure at conversion. This is for both 35 and 55-year-old workers. So, okay. Now let's look at the defined contribution plan. So this is going to be the plan the majority of students taking this course will be introduced to. So when you go work for an employer, most likely, if it's a non-government company, you're going to be working with a 401k plan. If it's a government related or educational related, it might be a 403b plan. They're both very similar. Now, the contributions to defined contribution retirement plans are limited. So these are some. I'm going to throw out some numbers here. These change all the time, but for right now, it's defined to 100% of earnings or $55,000, whichever is lower. And workers age 50 or older can make an additional catch-up of $6,000 per year. Okay. Now, more on those numbers later. So if we look at newly installed qualified retirement plans, are defined contribution plans. So these are basically 401k. So the cost to employer is lower because they're not going to grant any past service credits. This is all, and the employer, if they want, they don't have to contribute anything to the 401k. It's up to them if they want to put some matching funds into the 401k. So let's get to the disadvantages to employees. So remember that pensions are typically a better deal for employees where 401k, what we call defined contribution accounts, are less so, because employees can only estimate what their retirement benefits may be. They're not going to be defined. They don't know if it's going to be $1,000 a month or $3,000 a month because it all depends on the returns in the market. Investment losses are going to have to be absorbed by the employee. So in the pension plan, if the stock market goes down 50%, the pension plan is going to have to make up the difference eventually before you retire. If you have a 401k and the market goes down 50%, you're going to absorb that as the employee, and the company is going to have no responsibility for making up the difference. Also, the 401k leaves it up to the employee to decide where to put their money and where to invest the money. Where in pension funds, they typically hire experienced financial money managers to decide, or corporations or companies to manage the funds in a much more professional way. So this is an extreme disadvantage because pension funds have the luxury of hiring well-trained, well-educated financial planners and managers, where the 401k, it's all up to you to decide how you're going to invest. Okay, so the 401k plan, like I said, is the biggest qualified plan. Now, how this basically works is the employer is going to contract with a company like Fidelity to come in and organize a 401k for the company. And then the employer can contribute what are called employer matches to the employee's contributions. So what that basically means is they might say, if you contribute 4% of your salary, we'll contribute 2% of your salary. So what that means is if you make $100,000 and you put in $4,000 of your salary into a 401k, the company will match it at 50% and put another $2,000 in. So your total 401k at the end of the year would be $6,000 of contributions. So in a self-directed plan, employees determine how funds are going to be invested. And most 401ks are self-directed, so you get a choice of maybe anywhere from 4 to 40 different mutual funds that you could invest your money in directly. Now, employees voluntarily elect to have part of their salary invested in the 401k through what they call elective deferral. So you decide if you want to save 1 to 40% of your salary in one of these funds. And that brings us to the annual contribution maximum limit. So for the 401k, you will accumulate tax-free, and the funds will be taxed only at withdrawal when you retire. So all the money you put into the 401k plus any money that the 401k makes in capital gains or interest or dividends will be all tax-free. You won't pay any tax while you're working age. It's only upon the withdrawal of funds that you will pay tax. And this is a benefit because, say you're making $100,000 a year and you're pretty decently high tax rate for state and federal. So being able to reduce your tax liability by contributing to a 401k is a real bonus. It could boost your savings, your annual savings amount by 30 to 40%. Now, when you retire, typically you're going to be in a much lower tax bracket because you're retired, you have no income coming in. So say you withdraw $50,000 a year from your retirement plans to live on, you're only going to be taxed now at the rate for making $50,000, not $100,000. So theoretically, your taxes will be lower on your retirement than your working age. Now, for 2018, you're allowed to defer up to $18,500 a year into a 401k account, unless you're over age 50. So if you're age 50 or over, you get an extra $6,000 to contribute. Now, this changes. For example, I think now currently they've moved it up to $19,000 per year and $25,000 maximum for the year. So this number changes all the time. Okay, because it changes so frequently, I updated this slide. So now this is how the limits will change for year 2021. The contribution limit is unchanged at $19,500 for under 50. Now this catch-up amount is for people age 50 and older, will be up to $6,500. So that means that in the catch-up phase, you can deduct from your salary $26,000. And the limit for the employer-employee contributions will be to a total of $58,000. Now that's not, this is a combination of employer and employee contributions. So even though the employee contributions, the most you could, if you're age 15 over, the most you could put into a 401k is $26,000. But the employer can contribute an additional, say, 28,000 into your fund. Yeah, no, actually 30. Yeah, so if the total is 58 now, up to 58, minus the 26 you can contribute, that means the employer can give you another 32,000 if they chose to. I've never seen any employer put that much additional money in, but it all depends on your compensation and how much you're willing to match. So it is definitely open for employers to match much more, but there's no minimum. They can match zero if they want, but there's only a maximum amount. Okay, so there's an update for you. Okay, back to 401k plans. You have to, there are going to be penalties, just like the pension plan. If you're going to withdraw funds before age 59 and a half, you're going to experience a 10% penalty. And that could be, that's not 100%. There are some exceptions. So you could be permitted to withdraw funds for hardship. Say, for example, you've been evicted from your house. You have medical expenses. You're going to purchase your first home. You have educational expenses, funeral expenses. So there are some reasons that you can withdraw from your 401k. Now, most 401ks will have what's called a loan provision. And what this means is that the 401k will allow you to borrow money against your account, which is great because you don't have to pay a penalty when you do this. So say, for example, you needed $20,000 for a down payment on some sort of purchase. Maybe a new boat, maybe a new home, a second home. So instead of withdrawing the funds from your 401k and facing that penalty and also facing taxes, so if you make a withdrawal early from your 401k, you're going to have to pay tax on that money as well as a penalty. So that could be significant. So if you needed 20,000, you might have to withdraw 28,000, so you're left with 20,000 after taxes and penalty. Now, if you take a loan provision, there are no taxes or penalties, and you can just borrow. They'll give you money out of the 401k and set up a schedule for you to pay it back into your 401k. Now, the only problem is if you take a loan out of your 401k and you separated from your employment, you quit or get fired, you're going to have to pay that back or face the penalty and taxes on that money at a later date. Okay. Now, there's also a Roth 401k. So if you remember from the previous chapter, we talked about an IRA and a Roth IRA. So this works sort of similar to the Roth IRA, which means that you can make contributions. You can pay tax on your contributions in the beginning, and then when you get distributions, when you retire, they'll be tax-free. So you can accumulate. See, this is a benefit in a way that you're paying the taxes up front. Then your money will grow, and any accumulated earnings, capital gains, dividends will be all tax-free. So then when you retire and you withdraw money from this defined, this Roth 401k, you're not going to pay any income tax. So that's why it's probably a good idea to put some money both in a regular 401k and also a Roth 401k. So you would have the best of both worlds, and you are able to split it. You can't, double your contributions. You can't put in $19,500 in a regular 401k and another $19,000 in a Roth, but you can, put $10,000 in a regular 401k and maybe $9,500 in a Roth. You can split between the two, and that could be a good way of when you retire. If you have these both accounts, say you need $50,000 to live on, you can take $25,000 out of your Roth, pay no taxes, take $25,000 on your 401k, and only pay a very low tax rate on the $25,000. So it could be a good way of really maximizing your gains over a lifetime and minimizing your taxes upon retirement. Now, an individual 401k is a different type of retirement plan that's going to combine a profit sharing plan with a 401k plan. So this is a different type a plan altogether. Now, before I talk about this, I just want to mention some common mistakes people make with their retirement, and specifically with 401k plans. So the first mistake is not dollar cost averaging, trying to time the market with your 401k plan. So the best thing to do is put in a regular amount continuously in your 401k plan and never try to move money in and out of stocks as you think the economy is going to change or any type of market timing, or panic when the market goes down a great deal and sell everything in your 401k and put it into cash. And this is a common mistake most people have made. A second big mistake is not taking advantage of the 401k to its fullest and earliest. So you want to jump into this 401k right away when you start working and contribute the maximum to it that you're able to. Now you don't, another mistake is not taking advantage of the employee match or contribution. So you want to make sure that you get as much money from the company and contribute at least the max you needed to receive the full contributions from the company. So a big mistake with these 401ks is people generally don't put enough money away for retirement. And that is something that you have to be careful of. And also be careful of this common mistake where you're putting all your money into the company stock. So a lot of 401ks for companies that are public will give the option to invest in the company stock. And that is not a good way of diversify. So you don't want to put too much money just in one company's stock. Okay, so let's now move over to the individual 401k plan. So the individual 401k is going to provide, of course, this, tax advantages, but this is mostly directed to self-employed individuals, meaning you own your own company. So it's sort of like what we kind of refer to it as a solo 401k plan, where you're going to be, if you own the company by yourself or maybe a couple of partners, this is only a limited amount of people who are going to be involved in this 401k plan. So it's limited to the self-employed individuals, or business owners only. There's going to be no employees in this plan. And this is typically if you have a partnership, a corporation, a sole proprietorship, an S corporation that you own, you can set one of these up. So taxable income can be reduced by contributing to the plan just like a regular 401k plan. And the income is going to accumulate tax-free just like a regular 401k plan. So again, this is just the type of plan where if you're self-employed, you can still participate in a 401-like plan. Now, there are minimums and maximums as far as contributions. So in 2008, the maximum contribution was 25% of your total compensation. So you can defer up to $18,500, which is probably updated to $19,500, to reduce your taxable income. And of course, you have the catch-up of $6,000 or $6,500 in 2019. And as far as profit sharing, total profit sharing contributions cannot exceed $55,000 for the plan. So this again is a retirement plan for the self-employed, if you're going to be owning your own business. So this is something good to know about, because generally people who have their own business may not really think about retirement or save for retirement. So it's a good idea to see what's available if you do own your own company for the self-employed. And this is one such plan. Now, we're going to end this first part of the lecture here. And when we return, we'll begin with the 403B plan, which is going to be a tax-sheltered annuity similar to a 401k, but for a different group of employees. So we'll pick up this in part 2 of the lecture. Thank you for your time.